If you recall, the flexible or floating foreign exchange rate is based on a supply-demand model with no government intervention. As a result, these rates tend to be very volatile and unstable. However, you can determine the relative values of the currencies. We refer to the currencies as having a shared relative value because if one currency appreciates, then it means that the other currency depreciates. So what are these determinants or shifters? The first determinant is speculation. Currency speculators buy and sell currencies with an eye toward reselling or repurchasing them at a profit. Therefore, any action that would cause or speculate that the currency would appreciate would create a demand for the currency. It's a self-fulfilling prophecy. Take the example before you. Currency traders believe South Korea will have greater inflation than Taiwan. Since South Korea will have greater inflation than Taiwan, it means that their goods will be more expensive than Taiwan, making Taiwan's currency more lucrative. The South Korean currency, the won, supply will increase in order to obtain the Taiwanese currency, the new Taiwan dollar, in which its demand will increase. As a result, the won will depreciate and the new Taiwan dollar will appreciate. The next determinant is taste. A change in consumer taste for the products of a foreign country may alter the supply and demand for that nation's currency. For example, Mexican consumers are into popular video games in the United States. Since consumers in Mexico desire video games made in the United States, the supply for pesos increase and the demand for US dollars increase. The next shifter is relative expected returns on assets. Examples of these are stocks, bonds, and/or real estate such as factories. International investments in the stated items must require them to sell their own local currency to purchase the foreign currency needed for their overseas investments. For example, corporate tax cuts in the United States are expected due to low investment returns relative to those in the European Union. Lower taxes will motivate more investing. Therefore, there will be an increase in the supply of euros and an increase in the demand of dollars. Next is changes in relative real interest rates. If real interest rates in one country rise relevant to another country, which stays constant, the country with the lower interest rate will invest in the country with the highest interest rate to earn a higher return. Therefore, in the example, the supply of US dollars will increase while the demand of the pound will increase. Next is changes in the relative inflation rate. A change in the relative inflation rates between two nations change their relative price levels and alter the exchange rate between their currencies. The currency with the highest inflation rate has the fastest rising price level, leading to their currency to depreciate. Like in our example, the goods in Ghana are cheaper than the goods in the United States due to their rising prices. As a result, consumers are going to purchase more Ghanaian goods, increasing the supply of US dollars and increasing the demand of the Ghanaian currency, the cedi. The final shifter is GDP, Gross Domestic Product, the measure of a nation's income. A nation's currency is likely to depreciate if its growth of national income is more rapid than that of other countries. Why? As national income rises, the citizens will purchase more domestic and foreign goods, but other countries whose economies are stagnant will observe a currency strength. For example, the country of China enters a recession, reducing its imports, while the United States experiences a real output and real income surge. Consumers in the United States will increase the supply of their dollars, causing it to depreciate, and increasing the demand of the yuan, causing it to appreciate.